Hi, welcome back. I know I'm in the middle of data updates for 2021, but I thought I'd take a break today and talk about 6 companies that have been on my mind and I'm sure on pretty much everyone's mind. I'm talking, of course, about the FANGAM stocks: Facebook, Amazon, Netflix, Google, Apple, and Microsoft. Now, in the last 6 weeks, we've had some surprises come out about these stocks. And in fact, over the last year and a half, it does look like these 6 stocks, which have ruled markets for more than a decade, are no longer at the top of the heap. They're more in the middle of the heap. So here's the question I want to ask. Is this a temporary reprieve in this long-term march of these 6 companies to dominance? Or is this a falling back to earth? So as a lead-in, let's look at 2022. It's delivered quite a few surprises on stocks, right? Not only has the overall market been up and down and more down than up, the FANGAM stocks are back in the news. No surprise. But if you look at the FANGAM stocks, they've not all been in the news in the same way. Netflix and Facebook, after their most recent earnings reports, lost more than 20% of their market caps. Now, that might not sound much to you, but if you have a company like Facebook that's more than $1 trillion, a $200 billion write-off is what you effectively get in one day. At the same time, Amazon and Google actually delivered numbers that were above expectations. So in this post, what I'd like to do is actually take these 6 companies, look at what I saw last time when I looked at them, which was in September 2020, 9 months or 8 months into COVID, and then take a fresh look after all of the news and information we've got over the last 18 months. So let me take you back to September 2020 and talk a little bit about what drew my attention to these 6 companies. If you look at the decade from 2010 through 2019, it's quite clear that it was the FANGAM decade. And I'm not exaggerating here, because if you look at these companies collectively, they went from about 6.4% of the market to 15.2% of the market. If you want something that hits you even more, if you look at the FANGAM stocks and you look at their collective market caps, they went from being worth less than $1 trillion, $815 billion, at the start of 2011, at the start of 2010, to more than $5 trillion at the start of 2020. They added more than $4 trillion in market cap and accounted for a big chunk of the bull market over that decade. But I'll tell you even more what drew my attention to them in September of 2020. We were 7 or 8 months into COVID. The global economy had shut down, was partially reopening, markets had collapsed and were coming back. And the FANGAM stocks were riding the wave. Let me explain. Between February 14th of 2020, which to me was the official date of the start of COVID in markets in the West, especially in the US, through the middle of August, which is when I stopped this particular chart, the FANGAM stocks collectively, and so this is the heart of COVID, added another $1.4 trillion. So on top, I actually described this post as a strong becoming stronger, because here were these 6 companies that had dominated the decade, adding another $1.4 trillion in market cap over these 8 months. In fact, if you take the increase in market cap of these 6 companies out of US equities, during those 8 months, when people talked about how well US equities had come back, without these companies, there would have been no comeback. These companies single-handedly brought the market back. So I valued these companies in September 2020. I won't spend too much time on these valuations because I'm going to obviously give you my updated numbers. But at the time that I valued these companies, Facebook looked like the most undervalued company. And at least at that time, the most overvalued company was Apple. If you look at the rest of the companies, Amazon and Microsoft looked overvalued, albeit by less than Apple. And Netflix and Google were within shouting distance of the market price. At the time I did this valuation, I confessed that I owned 3 of the companies on this list. I owned Microsoft, Facebook, and Apple. I also said I was going to hold on to Microsoft and Facebook. But Facebook because I undervalued, and Microsoft because I didn't feel it was overvalued enough for me to pull the trigger. But I sold my Apple shares. Valuations have consequences. You're welcome to take issue with what I did, but that was what I did after my September 2020 valuation. So let's move forward 18 months and let's see what's happened over the last 18 months. Let's start by looking at the aggregate market cap of the FANGAM stocks over the 18 months. I'll start with the good news. Over the 18 months, the FANGAM stocks have continued to rise from about 7.8 trillion to more than 9.5 trillion. That's about a 21% or 22% increase in market cap. Pretty good, right? But if you look at the rest of tech, not counting FANGAM, those stocks are up almost 37%. And if you look at non-tech US equities, they're up 41%. For the first time in a really long time, the FANGAM stocks are running behind the market. Now, let's not read too much into that, but let's take a look at the 6 FANGAM companies to see how they individually did over this period. Breaking down the FANGAM into the 6 stocks, 3 of the stocks, Apple, Microsoft, Microsoft and Alphabet, have continued to have their run up. They've gone from Apple's up 30%, Microsoft 37%, and Alphabet up almost 69%. In fact, Microsoft and Alphabet have beaten the market. But 3 of the stocks, Amazon, Facebook, and Netflix, have all been down. In fact, much of the drop in Facebook and Netflix, if not all of it, has happened in the last few weeks after the last earnings report. So there are really 2 different stories being told by 3 companies, each of the 3 companies here. Now that's what the market did. Let's take a look at the operating numbers. I focused on 2 key operating numbers, revenues and operating income. Stepping back, remember, you want high revenue growth and high margins. And over this 18-month period, let's see what these companies did. In fact, to get a better sense of how these companies have navigated COVID, I looked at 3 years of numbers, 2019, 2020, and 2021. For 4 of these companies which have calendar year ends, these are actually calendar years. For 2 of these companies which have mid-year ends, September and June, I'm going to focus on trailing 12 months. So effectively, I have 3 calendar years for those companies as well. Every one of these companies posted not just solid, but high growth rates in revenue. Remember, these companies are already big companies and they're growing 18, 19, 20%. I think it kind of fills in that COVID story that these 6 companies, in one way or the other, have benefited from COVID and generated higher revenues. But what is even more impressive is what they've done with operating income between 2019 and 2021. You can't blame this on COVID. It's not a recovery from COVID because I'm looking at pre-COVID operating income. Every one of these companies also posted not just strong growth rates in operating income, but growth rates in operating income that exceeded the growth rate in revenues, except for Facebook, where it ran a little behind, but pretty impressive growth rate in operating income as well. Now, of course, there are lots of hidden things behind these numbers, and you can go dig through earnings reports seeing what exactly they contain. But I think one of the mistakes we make when we look at earnings reports, we get so focused on earnings per share numbers or revenue numbers that we miss the bigger story. In fact, as these numbers were coming out in the earnings reports, there are other news stories about these companies, and I'm not going to go through every one, obviously, because there are thousands, and I'm going to look at the key stories. Facebook and Google continued their privacy battle, where they felt pressure from regulators, from governments, to handle their data better, because both these companies are built on using the data they have on their users to better sell advertising. So they both felt the pressure. Google came out of it looking much better. They handled the pressure, partly because the pressure was primarily in YouTube, and the search box itself felt less of the pressure. Facebook, though, felt the pressure. In fact, it felt the pressure so much that in late October, it decided to rename itself Meta. And at the time that it did the renaming, I actually sold my shares. And you can see the record, but I did an interview then with Scott Galloway on Pivot. And I said, look, companies, when a name change is never good news. It's not good news for a human being or a person. It's not good news for a company. And Facebook, by the very act of changing its name, was telling me, at least indirectly, that its name had become too toxic. I know that their story was, we want to be part of the metaverse, but I don't buy it for a second. They took a long time establishing a name and getting it to be one of the best known corporate names in the world. You don't throw it away by renaming yourself. So that to me was a big story, because what that renaming told me a great deal about the pressure they were feeling from the privacy issue. more than anything I could see in the earnings report. It's true in the most recent Facebook earnings report, they did report that their user base went down by 500,000. Now that's tiny for a company, 2.95 billion users. It's the first time in Facebook's history that they've had a user count go down on a quarter-to-quarter basis. That said, though, it wasn't the government or the regulators that I think were the primary reason why the user numbers dropped. It was actually another company in this group, Apple, putting pressure through its privacy constraints on its devices. It's interesting that ultimately the pressure came from another one of the big companies, not from the government. It's a little bit like watching Godzilla fight King Kong when you see these big companies go against each other, but that's my impression. Now, on Netflix, the big stories actually were not the stories I read about Netflix, but the stories I read about Disney. For those of you who track Disney, during this 18-month period, Disney jumped head into streaming with Disney+. And not only did it kind of put all of its regular content, it became Netflix in terms of how much it was spending in content. In 2021, Disney spent more than $25 billion on content and plans to spend $33 billion next year. For the first time in Netflix's history, not only do they have a competitor in the streaming business that can match them in terms of content, but it's actually going to keep putting pressure on them to keep spending more on content. So to me, that was the big story for Netflix, is real competition emerged in the streaming business. Apple and Microsoft, ancient companies by tech company standards, kept their heads low. Maybe this is what you learn the longer you're in markets, is you don't want to put yourself in the middle of public controversies. In fact, Apple magically managed to put itself on the right side of the privacy debate. They became one of the good guys. Interestingly, in the process, they took a bite out of one of their competitors, so that might have been intended or unintended. But on the privacy battle, Apple clearly looked like a winner because of where it stood. Microsoft, for the most part, continued to make that transition from being a software company to a platform company. Let me explain. I mean, they still make a big chunk of their money from Windows and Office, but much of it is now delivered through their Office 365 subscription model, not by selling software. If you add the LinkedIn subscription model on top of that, you have two big platforms on which Microsoft is building up hundreds of millions of users. And in the last month, Microsoft made some news by going out and buying Activision Blizzard for $69 billion. Now, normally I'm not a fan of big acquisitions of publicly traded companies. This is an all-cash deal. But in this case, I would cut Microsoft some slack, perhaps reflecting my biases here. The first is that $69 billion sounds like a lot of money, and it is. But on a relative basis, it's a small acquisition for Microsoft. Why? Because Microsoft is a $2.2 trillion company. They bought Activision with cash on their balance sheet. They didn't have to go raise capital. Second, I think Microsoft has acquired some brownie points, some credit for the way it's behaved in the last 6-7 years. Under Satya Nadella, Microsoft has shown restraint. It's actually done things with a plan. And I'm going to assume that Activision is part of a bigger plan to keep building their platform business, that Activision is going to bring in users, probably younger, unlikely to be on Office 365, or at least less of an overlap. They're building out platforms, and this is a gaming platform. I know there are some who view this as a plan to take over the game business from Nintendo and Sony. I think Microsoft has much bigger plans. I don't think it's looking at Sony and Nintendo as its immediate competition. In fact, that's why I think it's going to keep the Activision Blizzard games going to those two platforms. It's going after Facebook and Roblox or the other companies that are in the bigger gaming platform market, where people essentially come in to game on a platform. So Apple and Microsoft took their own pathways. Finally, Amazon continued to be one of the companies that attracts controversy. It's done this right from its start. And it got it from every side, right? Politically, socially, everybody took on Amazon. But the amazing thing was, in spite of all of this pressure, Amazon's business model continued resilient. I mean, these news stories about Amazon drivers not being able to take bathroom breaks and overwork warehouse workers. And on top of that, you add the stories about Jeff Bezos now in the tabloid press about. But the amazing thing is, you got to give Jeff credit. He's built a business that outlives him, that essentially has continuity. And I think what I think struck me the most about Amazon was how, in spite of all of these pressures, Amazon continued to grow and become more profitable. So I'm ready to revisit my valuations. And as you well know, I think of valuations in terms of stories. The way to think about what's happened over the 18 months is, what have I learned about each of these companies that might or might not change their stories? Let's take the Facebook story. My original story for Facebook was it's a user colossus, almost 3 billion people on its platform who are on there for a long time every day, and the basis is you're going to be able to sell a lot of stuff. And that was my original reason for valuing Facebook the way I did in September 2020. Now let's face it, the platform is still huge, notwithstanding the 500,000 people it lost last year. It's still a huge platform. But I think the privacy backlash is having consequences. I think growth is going to be much slower. I think Facebook will have to spend more, which means lower margins going forward. My story for Facebook becomes more constrained going forward. Now, I think it'll find ways to make other money. Maybe it's the metaverse is a little too ambitious a target right now, but I think that's the end plan. If you look at Amazon, my original story for it in September 2020 was it's a disruption platform. Basically what I meant was, Amazon is not a retail company, it's not a logistics company, it's not an entertainment company, it's not a cloud company. It's a company that can go after any business with the status quo. It's become lazy and inefficient. Every business is fair target. That makes it a potentially huge business because you can be everywhere. What I've learned over the last 18 months is this is a remarkably resilient and well-structured company. I know regulators and governments are going to keep trying to hold it back, but I think this company will find a way, because of the way it's structured, to keep going and keep growing. In fact, I think one reason it's going to be so difficult to pin Amazon down with regulations and laws is it's like an octopus. It's in multiple businesses, multiple countries. It's not a single business company we can go after and say your market share is capped at 30%. So I think the disruption platform stays, but it becomes more resilient. If you look at Netflix, and I've also described Amazon as a field of dreams company, where it's over much of its lifetime, it's delivered revenues now, and if you wait, profits will come. Well, the profits are coming, so I think that you're going to see margins continue to rise. If you look at Netflix, it I wouldn't say created the subscription business, but it perfected the subscription business. And I think in September 2020, when I valued it, I gave it credit for the subscription platform. But even then, I mentioned what my caveat was, that Netflix had to find a way to bring its content costs down to make its cash flows positive and to be able to deliver value. At the time, in September 2020, I thought that they would find a way to bring content costs down as the platform continued to grow. And that drove my value. What we've learned in the last 18 months is the competition is now real. And I think that, if you think about Netflix as being on a hamster mill where it's constantly going, trying to get more users by spending more on content, getting off that hamster wheel would have always been difficult, but now it's become even more difficult. So my story going forward is getting users is going to get more difficult. It's going to get more costly. Reducing content costs is going to get much more difficult to do, and all of that is going to play out in the valuation you're going to see for Netflix. Google historically is really the search box that delivers value, notwithstanding all those other bets that make up Alphabet. And for much of its existence, the search box delivers the revenues and the bets actually spend the money. I think in the last 18 months, you've seen how good the search box is in delivering continued advertising revenues. In fact, Facebook's troubles are becoming Google's pluses. So I think the search box will continue to go. And in September 2020, I mentioned that I thought the bets would eventually start to. I think we're getting closer to seeing the other businesses that Google is in start to deliver profits. Apple, greatest cash machine in history, but that cash machine was run by one product, perhaps one of the greatest product invented by any company in history, which is the iPhone. A cash machine that wouldn't stop. And of course, the services business was already starting to kick in September 2020. In the last 18 months, Apple has pulled off another iPhone update. I'm sure at Apple, every time they do a new version of the iPhone, people must sit with bated breath because your entire value as a company rides on that update. Another successful update. And the services business continues to grow. So I think that the company continues to be a cash machine. It continues to be dependent on the iPhone, don't get me wrong, but it's building up its resilience in its services business. If the iPhone collapses, of course, none of that is going to protect it from a steep fall, but it's intact. Microsoft, as I said, transitioning from a software company to a platform company. And the breadth of its platforms, the number of users in its platforms suggests to me that that's one reason they went out and acquired Activision, to get a third platform with perhaps not as much overlap with their existing users, to bring in users, and to enter a different business on a platform business, the gaming business. So I feel pretty good about where Microsoft is going in terms of that multi-platform business. Now, to converting these stories into valuations, so you well know that I keep a fairly simplistic perspective on valuation, or almost every part of a story shows up as a number. 3 key numbers that describe your business model are revenue growth, margins, and to capture how much you reinvested, sales to capital ratio. I've kind of summarized what the numbers I used in each of these valuations was. And if you're interested, you can go back and check the full valuations to see these numbers play out in more detail. But you're seeing my story play out here in the numbers. I also ran simulations for all 6 companies, and you've seen me do this before. So you see the distribution of values I got. And in fact, I'm comparing the median value in the simulation to the stock price. There are 2 companies that look undervalued to me. One is Facebook, and no surprise, it was undervalued then, it's undervalued now. And it looks even more undervalued now than it did then. So it's also a company, obviously, that hasn't done well over the last 18 months. Lots of trouble, so I'm not trying to sugarcoat it. But the other is a surprise. I didn't expect to see this because Amazon hasn't been in my portfolio now for almost 6-7 years because it's always been so richly priced. First time in a long time, I think Amazon is undervalued by about 10%. Now, if you look at the other 4, they're overvalued, but none is outlandishly overvalued. In fact, if you look at 3 of the companies, Google, Apple, and Microsoft, they're closer to being fairly valued than overvalued. In fact, Apple and Microsoft, I think, are fairly valued. Google is slightly overvalued. Netflix is the only really overvalued company in this list. So let me summarize what I learned from the valuations. First, I think Facebook looks cheap. It looks cheap if you look at its earnings, its cash flows, its business model. But here's the catch. Its story has become muddled. For as long as I've known Facebook as a company, it's had a very simple and a very compelling story. A huge social media platform where people confess to details about their private lives, which Facebook collects assiduously and then uses as the basis for their business model. Let's be quite clear. Facebook's business model is built on invading privacy. But it's privacy that you gave away when you were on the social media platform. I'm not trying to defend them, but it's a little hypocritical to take issue just with Facebook. That story has become muddled with the name change and clearly the name change suggests the company itself is having doubts about whether it can sustain the story or tell it openly. So I take that into, I don't like buying companies on muddled stories, but it's so cheap that I can't overlook the cheapness. So you'll see this play out in what I've decided to do with Facebook. Netflix to me is the most overvalued company in the mix. I think and that might reflect my prior biases. I've never liked the Netflix model, which is to throw money at content, keep adding subscribers, go to markets, get your market cap up, and continue this on a bigger and bigger scale every quarter. Now that's why I described it as a hamster wheel. How do you get off this hamster wheel? And I've always wondered about this, but I just think that task became a lot more difficult with Apple Plus entering the market. The market getting saturated in the US and Europe, and everybody going after these same subscribers. Microsoft and Apple have kept their heads low. They're both overvalued, but very mildly. They're basically close to fairly valued. And Apple, seemingly has found a way to be one of the good guys. For Microsoft, I think buying Activision makes them much more of a platform business. So I like Microsoft and Apple as companies that are close to fairly valued. Google is slightly overvalued, but they surprised me with how well they did in these 18 months, because that privacy battle that's being waged, you'd think that it affected Facebook a great deal, seems to have not faced Google that much. They were able to grow fast, improve margins. Their search box continues to be the driver of value, but I think their other bets are going to start to pay off. And finally, Amazon. As I said, I was surprised to find it undervalued. It's a disruptive platform. It's my field of dreams company, but now the dreams seem to be coming true. I mean, that profits are starting to get delivered. You can't claim that this is all Amazon Cloud that is doing this, because it is across the board. I think you're seeing an improvement in margins. If you've seen the movie, Shoeless Joe is coming out of the cornfield. Amazon is finally, I think, making its transition, and I think you're going to see the profit margins continue to go up. Incidentally, in the last earnings report, Amazon announced that they were increasing the cost of Prime by $20. Might not sound like much, but when you have 125 or 150 million subscribers to Prime and you increase your price by $20, 150 times 20 is $3 billion in free cash flow you're adding every year. That's quite a machine you've got there. So what does it all mean? As I've said before, there's no point to doing valuation if you don't act on it. So I'm going to kind of list out my actions, not because I think these are the right actions, but because they follow from my own valuations. I came into the analysis holding Microsoft, and I'm going to continue to hold it. It's actually become less overvalued since September of 2020. I actually like the company more after its Activision acquisition, so I'll continue to hold it. I used to own Facebook, and as I said, I sold it after it changed its name because I was worried about the message it was sending about its story. But it's just way too cheap for me to leave out of my portfolio. So I'm buying back Facebook, and it goes back in my portfolio. And ESG people might not like me for doing this, but they don't pay my bills, and they're not going to cover my pension needs. On Amazon, a stock that I've held 4 times in the past, I bought 4 times in the past and sold 4 times in the past. The first time I bought Amazon was in 2001. It's a company I love, and at today's prices, I'm glad to have it back in my portfolio. It's good to be an Amazon buyer again. So Google, I've never had the guts or the instincts to hold it, and it's to my regret, because one of the great investments of the last 20 years. And but at today's prices, I can't see adding it on now. Maybe if the stock price dropped 10, 15, or 20%. As for Netflix, I just don't like the company. I just don't like the business, even with depressed prices, because I think scaling down content costs and adding users just got more difficult over the last 18 months, not less so. Needless to say, there's this broader question about markets and corrections and inflation and interest rates, but that's a different question. That's a question about how much money do you want to keep in equities collectively. On this particular session, I've looked at individual companies, and I believe in keeping the two analyses different. And I hope you make your own judgments. And that's why I've kept the spreadsheets open on these 6 companies, because you can't avoid them. You can't act like they're not there. You can't complain about them. You got to deal with them frontally. I hope you found the session useful, and I thank you very much for listening.